Hello everyone, and welcome to this latest video discussion as part of the RICS Tech Partner Programme. My name is Andrew Knight and I've been with RICS since 2011. I currently work in our thought leadership and analytics part of the organisation, and my role is to look at the impact of data and technology right across the built and natural environment. And with over 110,000 qualified members working worldwide, right across that property life cycle, from land planning and development, construction, brokerage, valuation, finance, building operation, building finance. It's a very, very broad church upon which data and tech and increasingly AI has a profound effect. And indeed, our members also work across all the major asset types, whether that's land itself, residential, commercial, alternative assets, and indeed infrastructure. And today I'm really glad to have Jordan joining me again from LifeProven. It's been a good few, probably a year or so since we last chatted, so great to have you on the call, Jordan.
Yeah, thank you so much. Yeah, I was thinking back actually, I think it's a couple of years ago that we first caught up. So yeah,
time is passing quickly. I mean, it'd be great for those who perhaps didn't watch that first video, just to start with perhaps a bit of an introduction to you and your backstory before we talk about LifeProven itself and the other issues.
Absolutely, yeah. So, well, firstly, thank you again for inviting me back. So my name is Jordan Relfe. I'm the co-founder of a business called LifeProven, which I'll go into in a moment. But my background is a chartered quantity surveyor. Been chartered for the best part of 12 years. Worked extensively across industrial, commercial, residential real estate in that role and that function. Kind of the most recent or kind of later part of my career before I started the business was as a development manager, working on a number of different schemes for private LLPs, and I was extensively working to get buildings forward funded and bringing my experience of delivery and starting to step into the realm of investment and finance. And it was through my experience that I started to see a shift towards real estate becoming appraised against the impact it was having on its stakeholders, not just its shareholders. And that was kind of the birth of LifeProven, really, as an idea.
And I know LifeProven itself has been on quite a kind of journey. Can you tell us where that's now ended up in terms of how you started and the kind of range of services and things you're working on now?
Yeah, absolutely. So you're absolutely right. The business has kind of shifted and pivoted and evolved as I think ESG and it's the space that we're in, and sustainability has really shifted and evolved in the last 5 years as where it is. I mean, today LifeProven is a real estate consultancy providing ESG services in the built environment. We work in an end-to-end capacity, providing consultancy, technical, data services to investment and asset level partners. And our role really is integrating the entire value chain as a single source partner. The shift and the dynamic nature of the industry, and certainly in ESG, and it's something that the industry is still running very fast to try and keep up with as to emerging threats and opportunities. But we've really seen that ESG in real estate has been so fragmented and disjointed. You have some really big specialized consultancies, you have massive scale data solutions, but actually we've seen a real failure to address equally kind of environmental, social and governance aspects of ESG and actually how they align uniquely to stakeholders across the entire value and supply chain. The business has really worked to unlock and is now where it's sitting quite successfully to support real estate funds and developers to kind of consistently navigate this journey through that entire life cycle, which is creating a lot of risk and uncertainty for those types of clients. And that's something that we've been focused very heavily on, is actually looking at the pain points of ESG. And I think it's been seen as for such a long time as a bolt on. We must tick this box, we must prepare this document, but actually it's embedded in the ethos of real estate, the ethos of business, and that's something that we've been very fortunate to work with some amazing clients to achieve.
Now, you've mentioned that the phrase ESG a number of times there, and I'm keen to get a bit of a drill down that from you in terms of your interpretation of what actually does ESG mean for the sector, both at that kind of macro level, but also at that kind of micro level, and also perhaps from a regional perspective, and obviously linked to the fact that there are drivers here either internally of the industry or externally from regulation. How would you interpret this huge swathe of what people very sort of loosely call ESG, but perhaps never quite define in terms of its real impacts?
Yeah, and it's something that we're constantly pushing to try and make as simple as possible when we're talking to our clients and industry partners. I think ESG in its simplest term is how a business is influencing the environment through both its corporate activities, i.e. the fact that it exists as a business, it employs people to travel to and from work, it rents offices, that has an impact. It's then also how their operation as a business, as a developer building or as a supply chain manufacturing, how those activities influence the environment. And it's looking at, certainly an environmental side, is how those activities influence the planet. Socially, how you're influencing people, and then lastly in governance, how you're influencing resilience, but also managing disclosure and building trust as part of that process. And for us, we've always looked at quite a macro level what the challenges are that ESG is trying to face when you look at it through that lens. And ultimately, you look at the biggest global threats at the moment, you can basically bucket all of those under ESG around climate. You've got extreme weather patterns and temperature changes, biodiversity loss, social impact issues of physical, mental health, unequal distributions of wealth, changing work patterns, resource issues, water scarcity, food production, energy generation are massive issues at the moment, economic challenges, cost of living crisis, inflation, currency devaluation, political challenges and military conflicts and regional conflicts impacting trade, and then security. You've got rise of powerful technologies or risk to finance and capital, and ultimately prosperity and mistrust of data and information. And to us, ESG is about how the constant balance and interconnected, interwoven and interdependency of all these issues are appraised. And that's both at a business level and both at an asset level. And those macro threats are being addressed at a micro level by market forces, by governments, by institutions, by country, by principality, or by councils and local authorities. And these micro responses are things like we're seeing as the minimum energy efficiency standards, or new reporting and disclosure requirements, or green investment. These are direct responses to those global macro threats, and those global macro threats are constantly changing. And that's I think the excitement of how the industry is evolving and becoming more resilient to change, but ultimately clients and investors and developers are struggling to keep up with this sort of micro response to what do they need to do and when. And I think we're seeing that those micro responses are really shaping the market. They're really driving where capital's being spent. They're really driving how real estate market is functioning. And ultimately, to us, that's what ESG is. It's almost ignore the acronym and look at what are the threats that are faced by our business, and is it going to be resilient to those threats in the next 50 years? And if it isn't, what do you need to do to address those?
I'd like to pick up again on a couple of words that you've used that sort of triggered me to sort of delve a bit more deeply. You've used the word valuation and appraisal, and what's your view of this kind of economic transformation? Because obviously commercial real estate is essentially an investment class for many participants. It's an income producing asset, and obviously there's now a reshaping, one could argue, of the sector in terms of how we look at appraisal and value, not only from a kind of brokerage and capital value and rental value, but from a design perspective and design costs and costs around embodied and operational carbon. What are you seeing as that shift in terms of how real estate is looked at as an economic asset?
Yeah, and I think it's something that Adam, my co-founder, and I think you and I have spoken about certainly offline a number of times. Is all of this is about the commerciality of delivery. I think these huge risks, but also opportunities, are driven by the financial impact, and a lot of these impacts and how they're being addressed is this going to save us money long term? Is it going to underwrite our value, or is it going to make us more money? And everything has to sit within those three boxes. If it doesn't, the market doesn't listen. And I think we have to step away from the ideology that we're doing the right things, we're doing the right thing. Businesses are businesses, and they need to make money, and that's not, profit isn't a bad marker. I think actually that then drives real growth and opportunities to make those decisions. But something we're really seeing at the moment is those macro threats and the micro responses is being really focused on the insurability and desirability of assets. And I think the market is really starting to understand with greater level of detail how exposed assets are to those threats over the long term. And that's really shifting allocation of capital towards, yes, we want to be in this use class, or we don't want to be buying in this area anymore. And I think we're seeing that assets are being bucketed into two pots really. One is that those that are resilient to those long-term changes, and those that are non-resilient. I think just an example of a resilient asset is over time the market value and desirability of those assets are enhanced based on the ability to address those macro threats, i.e. will this asset function in 30 to 50 years time? But ultimately that builds trust and security in the market, which attracts investment. You can disclose to your investors that this building will meet future legislation, it will meet physical climate risks. It's in a location that's supported by amenities, transport hubs. It's been designed with health and well-being in mind. It has the right ability to collect data to disclose its performance to the market. That's an asset people want. They know my money's safe in this building. And then conversely, on the other side is not addressing those issues over time, that market value and desirability will erode. Certainly with MEES is one of the biggest challenges. I think for landlords, whilst it's in consultation, it's still a very real threat. Is actually that if an asset can't be let or it's not resilient to those things, it's not going to be used, its value will erode. It's a simple case of supply and demand and desirability. And we're really starting to see with our clients addressing these things at every stage of their investment life cycle. In pre-acquisition, are we appraising every asset that comes into this fund in the same way? Are we looking at it at a fund level strategy to make sure this meets our long-term horizon and targets? That's then feeding round into the design requirements. So are we designing to the right targets? How do we ensure our design team have the right and correct information to rely upon, but also clear employers' requirements? And procurement, and something I'll come on to probably later on, I'll mention, but is around how important it is for the supply chain to understand the importance of these metrics and making sure that they are designing or delivering to those requirements. And ultimately, as that runs all the way through the investment life cycle to disposal then is, well, we're selling this asset. We want to make sure we can demonstrate its performance to attract the best value in the market, or we're going to be chipped on the price. Someone's going to come in and say, well, it doesn't meet these things. We need to do an assessment on how much it will be to address those upgrades. This is what we're going to discount from the purchase price. So I think these things are becoming more and more sophisticated, and our role is seeing a lot more of, we're on a pre-acquisition team with a couple of funds where we're verifying the performance of an asset based on a disclosure of information, and we're testing and pushing and saying, don't think your metric here or your calculations for whole life carbon modelling are right, or your operational energy looks a little bit high. What's this driven by? You've still got gas in the building to heat, communal hot water, and really looking at how does this materially influence that developer or landlord long term.
Fascinating. And I guess, I'm always going to ask this question in these kind of interviews because you're out actively in the market and talking to lots of different participants in different contexts. I mean, how would you summarize the key kind of themes, the kind of burning platforms, to use the jargon, that you're seeing across the sector when it relates to ESG? What would be the 5 or 6 key issues that you're coming, that you're challenged with, your clients are challenged with, day in, day out?
One of the biggest challenges that our clients are currently saying to us is, I know I need to meet a net zero carbon target, and I know I need to think about health and well-being, and I know I need to look at data, but how do I actually do that on an asset by asset basis? And we're working with a fund at the moment that's managed by BlackRock, and you've got 3 or 4 different use classes in that. Every building is of a different age. Every building has different technology in it. The buildings are being delivered by different development management partners, and actually that top layer strategy, delivering that on the ground and ensuring that everyone is working to the same in alignment with each other is very challenging. And that's something that we're actively fulfilling, is that kind of ESG project manager, where we're touching every point of that process to help them. But within the within the kind of the day-to-day challenges, once we've unlocked that, is MEES. The minimum energy efficiency standard is still a massive challenge and headache for clients. I think the uncertainty of whether it's actually be live in 2027 and 2030, I think is driving uncertainty, and banks and financial institutions are driving the directive that we need to meet that regardless, because that is a risk, and I think developers are being forced to address that now, and I think in some degrees rightly so, but I think it's very difficult for them to manage that process with uncertainty. Physical climate risk insurance, that's something that's really grown arms and legs that we've seen in the last 6 months at least, where the assurability of assets long term is suddenly becoming more and more prevalent, and the ability for not an asset in its design to meet those physical climate risks, but it might be at risk of flooding, for example, in the next 50 years. That creates huge uncertainty and financial risk, and how that's then being modelled and appraised, either in the disposal or pre-acquisition, is very uncertain at the moment. Biodiversity, and this is a topic that we're working very hard to be fully appraised of its impact. And really interestingly, we did a podcast actually with Ben Stansfield at Gowling's law firm, who specialises in kind of the biodiversity under TNFD disclosure regulations, and actually this is an issue that's more critical than carbon, given this is happening now, and carbon reduction is over the next 25 years, but this is an issue that needs to be addressed imminently, and it needs to be addressed now. And that's something that I don't think the market is fully understanding and fully appraising, and it needs to become kind of more prevalent, especially when you're looking at massive master planning schemes that have huge environmental impact. I think obviously within that, we spoke about the supply chain earlier and the influence that they have on the delivery. I think something we're seeing and have seen probably most recently, we've been asked by contractors to independently appraise the employer's requirements from a client certainly on climate related requirements or energy related and carbon related requirements and certification requirements. So we looked at a building, I won't say who the contractor was in Southwark, and it was the energy use intensity was ridiculously low. It was almost close to UK GBC target, and this was on an existing asset. EPC target of A needs to be BREEAM excellent, needed to be well platinum. And we've started looking into it. We're saying this is a design and build contract. If you sign up to these targets, there is no way for the budget that you've agreed with the client that this can be achieved. And I think there's a real danger that ESG in its old form of sustainability is a box tick. This is what we want to go for. Oh, it wasn't achieved. Okay, no worries. Now that that's being linked so heavily to the financial performance and desirability of assets, I think we're going to start to see some real challenges on litigation, ESG litigation. And I think that will happen if a fund is expecting to buy a building that's CREM compliant to 2050, and they said, yeah, it is now, and then they find out later on, no, it's not. They'll be looking back to say, well, who designed it, who built it, who signed up to these targets. And I think that is a challenge as the market's trying to work very hard to keep up. And that's something I think with the beauty of having an RICS background in quantity surveying, we're very much attuned to construction risks and the robustness of employers' requirements and making sure that those contractor CPs are managed effectively. Kind of bringing on to that is the viability challenges. Viability has always been a challenge in property, and I don't think it will ever change. But I think the complexities of viability at all of these stages, where clients are trying to work out what do I need to do and when and why, but ultimately how much is it going to cost me and what's the return that I get for making that investment. And at the moment they're faced with hundreds of options to address these massive macro issues through certifications, through design initiatives. It's not an easy task, and I think blending viability and real appraisal of costs with impact, I think is absolutely necessary. And I think lastly, obviously, data and being an RICS tech partner with you, Andrew, and the team, think data's still being seen as a bit too buzzy, and I don't think it's fully working. I think it's got ESG data's got a lot of room to work to, and you and I have spoken about this before, and I've heard you talk on the topic a number of times. Is ESG data actually starts with building information. It's the rawest of data is design, it's calculations, it's as-built records. What is this building currently designed at? And then from that we can make robust decisions to make interventions or to benchmark. So it's not very short summary, but it's kind of a run through of the key things that we're seeing at the moment. That certainly.
Well, no, I think in this context, a comprehensive run through is of great value. I'd like to go back to the value chain, if I may, and because it's clearly, as you know better than I, the complexity of our sector is the layers involved, whether it's a new build or a refit or whatever, and the supply chain all the way back to the original materials is it brings a level of complexity and challenge around management of that. I mean, how do you see? I mean, clearly it's an important, a critical part, but how do you see the value chain's role evolving in a good way to solve some of these problems? Because it feels like a really key part of this is this ability to work right through the value and the supply chain to actually make sure we do get this delivery. And as you say, that we don't end up with disappointed asset owners, if I can put that diplomatically.
Yeah, I think it's good, and something we see, and I mean, it's probably starting with ESG data to then lend about the importance of that value chain is through the requirement to disclose performance and actually demonstrate what's happening. That's either a target or that's actual. ESG data in its principal form is about benchmarking and disclosing how good are we doing or where are the gaps that we sit. And when you overlay that with how and who underwrites the value of our buildings, the value chain, it's about how do we use that data at each key stage to provide value and demonstrate to those partners just how close we are to aligning or what we're doing. And I think we're really making targeted approaches to the value chain with our clients to make sure that every person in that process is appraised and is on board. And I think that starts with capital markets, financial institutions. They're the ones that are lending. They're the ones that are providing reductions in debt as a result of meeting these long-term requirements. We have stakeholders, the end user of buildings. They're the ones that ultimately are buying into what you're creating. We have the supply chain, the contractors. They're the ones that design and build your assets. You need to be working with them to ultimately create these buildings and the design team. So I think that the value chain ultimately all the way through that process, and who we're talking to, like local authorities, they're the ones that consent you planning for a scheme. And ultimately it's about working with them because they underwrite the value of your asset. And I think demonstrating and disclosing to those partners in targeted communication is fundamental. And I think it's fundamental to kind of meeting that financial resilience. If you can address with equal weighting those partners. Traditional model is work very closely with the financial institution, agree some really good targets, and then that kind of gets put in a drawer, and right, we just traditionally try and design and build and put it onto a long lease and sell, or just sell to the market without any or little thought. But actually councils want to see, and local authorities wants to see, this building is going to meet our climate requirements, it's going to meet our social impact issues. How is the buildings or the assets that you're looking to develop going to support and grow and work long term for our community and work for our for our local members? And I think that again, by being so transparent and so driven, so solely focused at each stage by the requirements of that party, you're building value for your asset. And I think that's something that I think is really fundamental.
Indeed, and I'd like to go back. I keep going back to sort of pick up on things that you've said, and around ESG data. And I'm always a believer in the kind of concept of how we turn data into information. And there are obviously there's the context of an existing asset that one might acquire, or clearly from the ground upwards a new asset. How would you summarize for our listeners and viewers really what is ESG data? Because it's a huge sprawling topic in some respects, but you need to start with a degree of granularity of the data you can get, as I say, either through the design and construct phase or indeed with an existing stabilized asset. Where do you start with data gathering and deciding what's important?
Well, ultimately, we look at, and that's driven by the top-down strategy, whether that's a strategy for a single development or a strategy for a portfolio or a fund. We're looking at the long-term risks of that portfolio and the long-term opportunities. So we know in 2050 we need to be net zero in operation. We know that we need to be improving the health and well-being of our occupants. We know that we need to be achieving a energy intensity target of X. We know we need to be EPC B or A, depending on new or existing assets. So that kind of top-down strategy is how is this fund or this asset going to meet those long-term threats and be resilient to what it needs. The layer down from that is then saying, well, at what stage of the investment life cycle do I need to be collecting information to demonstrate my performance against those targets or those commitments and initiatives? And ultimately, you'd say, well, and actually come back to a point interestingly we're saying about it starts with the rawest, the building information. If you're buying an asset and acquiring an asset, you want to know, okay, well, what's its current performance? What's its current energy use intensity? What's its current carbon intensity? What are the walls constructed of? What's the U value of the windows? What's the current EPC saying? What's the efficiencies of the M&E systems? How old are they? How well have they been maintained? That is really, really fundamentally ESG data in a nutshell, is what have I got information on this building? Because then as you move through the cycle and the stages, you start to say, well, okay, against our alignment, we need to make sure it's got no gas if we're Article 8 fund under EU, under SFDR, for example. And it's ultimately looking at each one of those stages to say what information at each stage do we need to gather to align to that massive strategy. So if we're going through construction and procurement and actually on site, then you'd start to say, well, we need to collect our Scope 3 emission data from the contractor that's building this asset for us or refurbing it for us. They need to be providing us with the environmental product declaration sheets for the materials that have gone in. They need to provide how well this building can be dismantled or deconstructed in the future. They need to provide us with the commissioning certificates and records, the health and safety data to prove what we've done. So it's kind of layering up as you run through. And I think where at the moment employers or funds and asset owners are coming a bit unstuck is they're kind of getting plugged in with a technology solution that picks up energy data in operation, but that's not actually the full life cycle picture of what happens to this building. And ultimately you start with that. Potentially you start measuring operationally, and that's a really good start to actually work out where we are. But then that might drive, okay, well, our EPC needs to be improved. Ultimately, to improve that, we need to know what's the building currently designed to, what's its U values, how's it, what's the construction of this. So I think it's ESG data isn't just numbers on a spreadsheet. It's not just a dashboard that says red, amber, green of where you are. It's multi-layered and it's multi-used throughout everything. And we're uber focused on building data in terms of its rawest form of design, of calculations, of maintenance records. And I think interestingly, it's from that data, it's then, why do you collect ESG data? Well, it's obviously to disclose to the market your performance through disclosure regulations if you're a certain size. It's actually to disclose to the market if you're trying to let or sell, just how compliant that is. But it's telling a story to each one of those value chain partners, to your capital markets. It's saying, this is how we align to what you're doing. This is exactly what we're trying to do. But it's also providing you with a benchmark of your own performance as a business that you can then use and validate. And I think it's really crucial that the data is consistent across multi-asset use classes, but it's also appraised in a very consistent way. And I think that's a challenge that certainly portfolio holders are having at the moment, and certainly individual developers that might be doing one or two assets at a time. It's really difficult to then keep up with, well, who's buying this asset, what do they need, or if I'm forward funding it, it might be different requirements for different parties. But yeah, I think in ESG data, that's how we certainly appraise it.
And I suppose that does reinforce how important it is to think very carefully about how you do actually communicate and report ESG performance, because it's clearly got to be credible based on data that itself is credible. And I think that's I guess it's been an issue for the sector, isn't it, that they haven't had the data, and even when they do, they need to make sure that there's no sense of in any way greenwashing in that sort of thing, isn't it? So there must really be a very strong strategy about how you make sure you can report credibly on your assets, either individually or at a portfolio level.
Yeah, absolutely. And I think it's using that information strategically, and where we come back to the point around dashboards of numbers. And a big role that we're fulfilling at the moment for funds is we're managing their third-party data collection platform, because they might have hundreds of buildings in that with all this information. They need someone to extract that and tell a story depending on who that information is going to. And it's certainly where we come back to the complexities of real estate and how siloed and fragmented it is, that I've certainly, and I'm sure people listening have been there as well, and you might receive a very technical energy report for the purposes of planning. No one understands what it means or how it's being used apart from the person that wrote it. And I think getting away from very technical reports that don't tell a story or appraise back to an aligned vision, I think is a challenge. And I think that's where this strategic communication comes in. We were asked to do a net zero transition plan for general projects recently. We did a very technical report that had a TM54 energy model set behind it. We did a cost plan of how much the interventions would be. We did a program of delivery with procurement advice. We did all of that, and that was really well and understood by the asset management team. We then did an occupier-facing version, which talked them through very simply, these are the things that will need to happen. This is the journey of the asset. This is what actually net zero in operation means. This is what it's going to cost. And I think tailoring the information depending on the readership and the value chain, I think, is hugely important to unpick what's important to them. And someone said to us recently, an investor doesn't want to see a dashboard. They want to read a story about what are the biggest risks I'm faced with, what's exciting, what's new, what's coming up. And I think that's something that we've really listened to and really pushing with.
It's that fundamental 101 about knowing your audience, isn't it? That the information might be the same, but the presentation layer is going to be difficult. So, I mean, thinking to the future, what are the next steps for you and your colleagues at LifeProven?
Yeah, so we're